adjusted trial balance that you're going to prepare should show the updated amount post-adjustment, which is $1,200. Okay, so this is what the adjusted trial balance is. If I provide you a pre-adjusted trial balance, right, and ask you to write adjusting entries, and then I ask you to prepare the adjusted trial balance, you are going to factor in each adjusting entry, which account did it affect, and what is the post-adjustment figure. Okay, so adjusted trial balance would have all the items or all the accounts that the company has. Of course, we would have assets, we would have liabilities, as well as shareholders' equity. Okay, so that is for the adjusted trial balance, right? And after we prepared the financial statements, as we saw in your assignment 1, of course, we then went on to talk about inventory and purchases, right? So this is the next topic that I wanted to talk about. For inventory and purchases, right, I introduced to you the concept of a purchase credit and discount, okay? And so let us go through this example together. On 3rd of November, right, the company purchased some spreadsheet programs from PC Products for $10,000, and it has a credit term 2, 10, and 30, and it was paid on 7th of November, okay? To recap, the credit term 210, meaning if you pay within 10 days of receiving the invoice, you would enjoy a 2% discount, right? Otherwise, if you do not want to pay within 10 days, you have to pay the full amount within 30 days, and therefore it's N30. Okay, recall that in class I told you before you get excited to calculate the 2%, first of all, you should determine whether the discount should be applied, right? And in this case, it was paid on 7th of November, which is just 4 days after 3rd of November. And so in this case, the credit discount actually applies. Okay, so then you can write, in the exam, you can write, remember to include discount, okay, when you write the journal entries. So what are the different entries for purchases? There are two kinds of journal entries. The first would be to record the increase in inventory, right? You purchase spreadsheet programs and that's going to increase your inventory, right? So I'm going to debit inventory, $10,000, credit accounts payable, $10,000. Okay, because on 3rd of November, I have yet to pay up the price for the inventory. And so I'm going to credit AP to remind myself to pay later on. Now, on 7th of November, when I finally paid it off, I'm going to reverse the full amount of AP, which is $10,000. So debit AP, $10,000, right? And recall that I took advantage of the credit term of 2%, and 2% of $10,000 is $200. So I am only paying $9,800 in cash. So credit cash, $9,800. And the remaining discount of $200, I'm going to reduce the value of my inventory by doing credit inventory, $200. Okay, so recall that the definition of inventory would be whatever cost is incurred to prepare it ready for sale, right? And in this case, because we actually had a discount on the inventory, the cost that we pay for the inventory is lowered by $200. And so here we are going to reduce the cost of our inventory in our own internal accounts, and therefore we are going to credit inventory $200. Now, what about transportation costs, right? If you remember this figure, I said that there are two kinds of shipping cost policies that businesses would use. The first would be FOB shipping point, right? Shipping point meaning that the ownership passes on to the buyer from the shipping point, and therefore, if the buyer owns the goods from the shipping point, it means that the buyer is responsible for the freight or for the shipping cost to bring it to wherever it wants to sell the goods, right? And on the other hand, if it is FOB destination, the ownership only passes on to the buyer as at the destination, meaning that the seller is actually in charge of paying for the shipping cost, bringing the goods from the warehouse to the buyer's storefront. Okay, so FOB shipping point once again tells you that the buyer pays for the shipping cost, whereas for FOB destination, the seller is going to pay for the shipping cost. Okay, so just recall these two terms, and so you would know if you're the buyer or the seller, should you be recording the shipping cost based on what are the shipping terms. Okay, so after we purchase the products, right, I also taught you a few methods to do inventory costing, right? So when we have inventory, we have purchases, we have sales, and how do we record the value of our inventory at the end of each period? Okay, I introduced to you this format to track the inventory, and you guys also practiced it in class as well as through your assignments. Okay, so when we have purchase of inventory, right, we would record that in these 3 columns. When we have sales of inventory, we would record them in the next 3 columns. And finally, we would have the balance updated after each purchase or sale. So in this example, right, on 5th of January, we purchased 2 units at $1,000 each, right? And so the balance would be 2 units. Unit cost would be $1,000, right? Total is $2,000. On 5th of February, okay, we purchased 3 units for $1,200 each. Total, we spent $3,600, okay? And the total balance of units would be 2 plus 3 equals to 5, right? And the total cost would be $5,600 divided by 5, which would be 1120. Okay, so in this example, we are using the average cost method. So we can simply take the total cost of the inventory to date divided by the total units we have on hand to arrive at the simple average of 1120. Now, on the 1st of March, we then sold 1 unit. The unit cost would be 1120 as taken from the balance in the previous row. right? And so we would have remaining 4 units left over after selling 1 unit. Unit cost remains unchanged because there were no new purchases, and total inventory balance to be recorded on our balance sheet would be 4480. Okay, this is the simple kind of average cost method. Now, I also introduced to you guys the first in, first out method, or the FIFO method. Okay, this would mean that whatever inventory we bought first, okay, we would use that cost in recording the sales, right? So the kind of the top would be the same on the 5th of January, right? What is different is on the 5th of February, after we purchase 3 units, we are going to split out the balance as such. We are going to have 2 units at $1,000, 3 units at $1,200. This tells us that any sale should be first taken from the $1,000 before we move on to the $1,200. Okay. 1st of March, right, we sold 1 unit, and we know that first in, first out, the first unit that we bought cost $1,000, and so our unit cost would be $1,000. Okay, and the balance would be out of the 2 units at $1,000, we sold 1 of it, meaning that we have 1 left, and so the balance is 1 unit at $1,000 and the remaining 3 units at $1,200. Okay, so first in, first out kind of requires us to list how many units at the cost price, how many units at the cost price, so that when we do sales, right, we know which chronology to follow, right? It's always the first one that entered first. We would use that cost when we are doing sales. That is first in, first out. Okay, so after inventory, we also moved on to kind of accounts receivable. And when we were introducing the accounts receivable accounting, right, I also talked about the concept of uncollectible accounts. Okay, so in this example, world famous toy company begins its business on 1st of January 2021, and on 31st of January, the total AR was $250,000. Okay, as of this date, right, the credit manager, based on his past experiences, reviews the AR and says that about $10,000 of these accounts would be uncollectible eventually. Okay, so don't worry about how to calculate this $10,000. If I were to test you in the exam about uncollectibles, I would directly give you the $10,000 without asking you to compute it, right? But of course, in class, I did kind of go through in businesses how they actually compute the $10,000, which is to assign a percentage of uncollectibleness to each of the aging of AR, meaning that if it is not overdue, maybe only 1% would be uncollectible. If it is 30 days overdue, maybe 5% would be uncollectible. Okay, so that's how they do it kind of in practical sense. But for the purpose of your exam, you just have to know how to write the journal entries. Okay, so what is the adjusting entry to be made on 31st of December, right? First up, we would have the uncollectible accounts expense, right? And for expenses, we are going to debit it. And for credit, we would credit the allowance for doubtful accounts, right? Allowance for doubtful accounts is a contra asset account, meaning that it reduces the value of our assets, right? So the main asset account that it is tied to would be AR, okay? And allowance for doubtful accounts is going to reduce the value of AR such that the net AR total value would be reduced by $10,000. Okay, so once again, I'm going to debit uncollectible accounts expense, credit allowance for doubtful accounts. Now, how about for notes receivable, right? Recall I said that if a company has accounts receivable, right, with its customer, and later on the customer is unable to pay up, right, it is common business practice to then convert this AR to notes receivable. Okay, what is the difference between AR and notes receivable? The main difference is the collection of interest. For AR, we pay the net value probably within 30 days, and we do not ask for any interest for that 30 days. However, if it is overdue, right, more than 30 days, then it could be converted into notes receivable, where the seller would start to charge interest for its for it being overdue. Okay, so for example, right, on the 1st of December, a 3-month 6% note receivable is acquired from a customer to settle the existing AR of $60,000. So in this case, the customer owes the company $60,000, and he kind of needs 3 more months to repay it, and in return, he agrees to pay 6% of interest. Okay, how do we account for something like that, right? The appropriate journal entry when you first convert AR to notes receivable would be, of course, to reverse the AR, right? So AR usually has a debit balance because it is an asset account. So debit balance, if I want to reverse or make it 0, right, I'm going to credit AR 60K. At the same time, I'm going to create another asset called notes receivable. So debit notes receivable 60K. This first journal entry is to simply move the balance from AR to my notes receivable account. Okay. Now, 1 month later, the company wants to do its closing books, right? So therefore, it needs an adjusting entry. And on 31st of December, how do we compute the interest earned on this particular note, right? We would take the principal amount, $60,000, multiplied by the annual interest rate, 6%, then multiplied by 1 out of 12 months to show that we are accruing for just 1 month of interest. Okay, that would be $300. So in this case, I would debit interest receivable $300 and credit interest revenue $300. Typically for notes receivable, right, the interest would only be paid together upon expiry of the note, meaning that if it is a 3-month note, the company would only receive 3 months worth of interest upon repayment of the full 60K principal amount. And so in the interim, right, they have to record a interest receivable account to kind of tell themselves that, hey, you have to collect this interest in 3 months' time. Okay, so that's for notes receivable. Okay, so this is kind of going further into depreciation, right?